My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends. I'm just trying to make a little money. My job's not just to entertain, but to educate and teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Now, for weeks, I've told you to stick with this market throughout the turmoil, because by the time something good happens, it's already too late to swap back in at the lower level. You won't get the lower level. And sure enough, today we got good news in the form of a strong labor report without a lot of wage inflation, a true Goldilocks set of numbers. So in response, the Dow surged 71 points, the S&P soared 1.45%, and the Nasdaq pole vaulted 1.07%. It was a real good day for the bulls. Bye. What's a Goldilocks situation anyway? Well, exactly like the fairy tale. It's where everything just kind of works out right. Now, I don't think that will ultimately be true, but I do think that this labor report that we got this morning makes it more likely that the Federal Reserve will pause and ponder this next meeting rather than feeling the need to tighten again immediately. Of course, when you throw in a new stimulus package in China, along with the surprisingly easy passage of a debt ceiling deal in Washington, well, maybe you get a grace day, maybe you get a grace week. But like I told you last night, this market has been entirely propped up by the Magnificent Seven, the 7 mega-cap tech stocks that accounted for the entire gain in the S&P 500 through May. That's what tided us over. Now that we put the debt ceiling in the rearview mirror, and the Fed seeing data that allow them to pause the rate hikes, it's easy to imagine a near-perfect scenario where a recession could be taken off the table even as the Fed's done tightening. But remember, we liked the market when it was hated. I am starting to talk more negatively beginning on Monday as this market gets broader, because I don't love a market where everybody's now coming around to our bullish way of thinking, because the market is now broadening away from the Magnificent Seven. I liked it more yesterday than I do today because it's higher, and that's how you have to think. With that in mind, what's coming next week? Well, first, there's an OPEC meeting this weekend. It's called OPEC Plus. It's kind of like, like all those different HBO Plus, which is now Max, by the way. Anyway, this meeting could be very interesting, a wild card. They might hurt us with the production cuts to bolster the price of oil. But if so, I will most likely tell you to sell, as I will try to sell some oils for our trust, because I don't want to overstay our welcome in a very difficult group. Much more on that at the CNBC Investing Club meeting at 10:20 Monday. Now, the big story Monday is the beginning of the Apple's Worldwide Developers Conference. That's a showcase of products, ideas, and software updates. I think it is a fool's game to try to trade Apple, which hit a new 52-week high today and is now within $2 of its all-time high, which is why I always tell you, just own it. More on that later. We also have 2 analyst meetings that are being held on the sidelines of the American Society of Clinical Oncology, or ASCO. It's an annual meeting that could capture some big news. First, there is Moderna. Right now, we had them on recently. That's the company that first cracked the COVID code, but it hasn't been able to find convincing footing ever since dropping precipitously once the pandemic ended. Hey, maybe they got something up their sleeves. Maybe related to personalized cancer vaccines, which is something that I know they are working on. Stefan Bancel, smart guy. Then there's Merck's analyst meeting. Merck sold a drug for post-infection. They made a lot of money, and they're buying Prometheus Bio for nearly $11 billion to bulk up their autoimmune pipeline. That said, I think this meeting will mostly focus on their oncology products, which are the best in the breed. Okay, remember, it's Keytruda, and there are a lot of different things that Keytruda is going to be revealed, I think, that can also conquer that we didn't even know they were able to. A very profitable part of the franchise. Tuesday, JM Smucker reports. Now, this will be an important tell for the consumer packaged goods place. Smucker's been delivering, but its stock has stalled out lately because Wall Street's lost interest in the defensives. They only want the Magnificent Seven. If Smucker's good, the money might flow back into this now beleaguered group. We got a bunch of important analyst meetings on Tuesday, too, including First Horizon and another ASCO-related event from Bristol Myers. First Horizon is a regional bank that got a raw deal not that long ago when regulators forced Toronto Dominion to back off from their takeover bid. First Horizon now trades about 11. TD is willing to pay $25 before the mini banking crisis. I think it's a strong buy here. You know I like it very much, and I would buy it ahead of the analyst meeting. I say that as someone who does not care for the regional banks. As for Bristol Myers, the departing CEO, Dr. Giovanni Cavario, was on with Kelly Evans today in a great interview, talking about his terrific anti-cancer franchise and what Big Pharma can get out of AI. The stock's been terrible lately. It's down almost 9% for the year. But maybe we can see a broadening to pharma if Bristol Myers raises estimates at the meeting, or at least shows us it's got something new to get excited about. Now, if Smucker takes off on a good day, you know what? You might want to buy some Campbell's soup, as the company's doing much better than the stock's saying it is. And that's because CEO Mark Klaus has been executing a multi-year turnaround. He inherited a very difficult company. Campbell's down more than 10% from its high. I like the odds there. Next, the always controversial GameStop might tell a good story about an upgrade cycle coming thanks to products powered by NVIDIA. It'll be meaningful hype. But GameStop loves to wrap itself in any hot trend it can find because it's real business. Selling gamer stuff that's easier to buy online has gone ice cold. They're very good at hype. Hype per share, excellent. Now, we have an analyst meeting for Brinker. That owns the always popular, it's always packed, Chili's, and then Maggiano's Little Italy restaurants. This is one of my favorite companies. They're going much more upscale, making a lot of money in the process. Stock's up and astounding 25% for the year, despite people paying no attention to it at all. All the restaurant love goes to Darden and Cramer Fave Chipotle, where I had a great bowl today. It was really sensational. The stealth nature of the move makes no sense for me, because CEO Kevin Hochman is a total winner with a good strategy that's getting great. And it will only get better as the food costs go down. And that is already happening. Labor getting cheaper, easier to keep managers, which is really helping Brinker. Don't overlook it. Hey, speaking of well-run, how about considering Signet Jewelers, which is doing so many good things under CEO Gina Drosos, by the way, a Georgia Bulldog, which now means she's an Eagle fan. She has a terrific direct-to-consumer business and an excellent house of brands. It's a little puzzling, I find, that the stock's down about 4% for the year. And at 65, it's well off its $83 peak. I bet she has a good story to tell, as she did at that analyst day where she came here not that long ago. Here's an interesting one, Vail Resorts. Now, my wife, Lisa, recently came back from a skiing trip at the Vail Resorts, which the company only had an okay quarter. She had a great time. I think it's a bargain trip. I saw the bills. Goes right along with the rest of the travel and leisure theme that's rocketed higher today. American Express and Marriott led the charge. It's tough to value Vail Resorts, sells at 33 times earnings, 3.3% yield, not to mention strong management. But you know what it is? It's part of that theme I keep telling you about. We are all long on money, but we're short on time. That's what we realized post-COVID, and people are going to Vail Resorts. Now, what else? This market always seems to stay negative on the premium COVID plays, no matter how far the pandemic gets in the rearview mirror. The only thing worse than a pure COVID play is an ancillary COVID play, like Zoom or the one we hear from Thursday, DocuSign. I used it today. I love it. It's kind of like, it looks like Jim Cramer, you know. Well, you know how it works. This company changed how we buy real estate forever. But unfortunately, the stock has stumbled as they now face real competition and struggle to do good, to put up good numbers. I think DocuSign is still too close to its post-COVID hangover to touch. Thursday, also, we had an analyst meeting, PayPal. I don't know how it's going to come out. But ever since July of 2021, it's been all downhill for this company. I don't know what can turn it around, as it's now facing a ton of competition. The best I can say is it's probably too late to short it, but I don't want to be a buyer. Friday, we're going to go back into that world of China again. People are going to be talking about NIO, the Chinese car that's allegedly taking it to Tesla in its home market. All I know is that if China follows up in its attempts to re-stimulate the economy, as you heard last night, this one will pop, but then you have to sell. Bottom line, after this week, we'll just be hearing endless chatter about what the Fed will be doing. My take, I think they'll still tighten another 1 or 2 times, but almost definitely not at next meeting. Either way, for club members, here's what I'm saying. We are not going to overstay our bullish welcome mat because others are stomping on it, just when we saw and predicted that the market would go from narrow to broad. And when that happens and everybody's in your boat, it's time to say goodbye. Alex in Kentucky. Alex.
Hey, Jim. Good to hear from you.
Thank you. Same.
So I've been really interested in following Spirit Airlines and kind of JetBlue and seeing what's going on with all that. With that, I was just curious what your thoughts are with all the recent kind of developments.
The only ones I really like, I like Delta and I like United. And I don't want to get in this group that heavily now because we're pretty late in the in this travel and leisure trend. It's still working, but I don't want to overstay in the railroads. I'd rather you overstay in the Marriotts, and I'd rather overstay in the restaurants. Let's go to Michael in Texas. Michael.
Hey, Jim, big fan. Love CNBC. Love your show. Thank you so much.
Thank you. Love the network.
I wanted to ask your opinion about Lockheed Martin. They have a strong presence in the defense industry. They've had some great contract wins, but there've been some big government budget cuts. I want to see what's your take on LNP?
I think Jim Taiclet is bankable. He's the CEO. I think we're now through the debt ceiling issues. I think at 460, it's going down. It's down 6%. I think it can kick up quickly, be up. I think you can catch 10% move here in Lockheed. That's how those stocks traded last time in 2012. Once we saw the writing on the wall, boom, bingo. Yes. Tony in Washington. Tony.
Mr. Cramer, a big Gonzaga Bulldog booyah to you from Spokane, Washington.
Well, I can only say good things. That's it. Zags, love.
Love the Zags. So I've been very fortunate to be along the large cap tech names that have seen big run-ups recently to the AI craze. I'm wondering if right now is a good time to skim some profits off the top of those and reinvest them in one of the laggards in my portfolio. And that would be Dutch Bros, which is down recently on.
All right, here's what I'm going to say. Josh has to stop growing so fast. He's going to hurt the company. If he were here right now, I'd say, listen, I don't know coffee like you do. I don't even know the Annihilator, although I love to drink it. But I know stocks. Stop the over-expansion. You're hurting the franchise. Protect the franchise. Right now, the debt ceiling drama is over with. The focus will turn to the Fed. And I think they will take a wait-and-see approach with the rate hike cuts. But remember, everybody's joining the bullish party, so you know what you have to do when that happens. Sell. On Mad Money tonight, as the inflation picture adjusts, many investors are fleeing the defensive stocks like the packaged food place. Tonight, I'm sitting down with the CEO of Hostess, yes, Twinkie, to find out how they're positioning itself in the current environment, and it's darn good. Plus, now that we've heard from nearly all the cybersecurity outputs, I'm offering my key takeaways from the reports. But first, Biohaven is flying higher after there's R&D. It's up, R&D day. It's up 40% just in the past week. I'm sitting down with the CEO to find out if the stock can continue its move. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com. Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.